What does a TFSA stand for? Where can you get one? How does it really work? What is tax-free in a TFSA? What are the limits, the qualifications, the tax ramifications? And finally, what are the most common mistakes Canadians make when they invest into a TFSA and how you can avoid one? If you have any of these burning questions on your mind, then you are at the right place. Hi, my name is Gaurav, and for the past 15 years, I've been helping clients save money in the right places. I've also got my MBA in finance from UBC, and in this video, I'm going to share with you all things TFSA. We're going to be covering many topics such as these. So let's get into it. Before we start, there's something you need to understand about investments. You'd want to understand the bucket and the fuel analogy. Or in other words, you have to understand an investment account and the type of investment. An investment account or the bucket decides on how your money will be taxed. The investment options or the fuel that you put into that bucket decides on how your money will grow. When most people think of investing, they think of only the type of investment choice they can make. TFSA is a type of bucket. So let's talk about the investment options inside a TFSA or the fuels. You can put your money into very safe investment options such as a savings accounts, a high interest savings accounts, or a GIC. These will provide you safety but will be limited on the growth. Or you can invest your money in other places such as mutual funds, ETFs, index accounts, or stocks. They will provide you much chances for growth, but they lack on the safety. Or you can choose segregated funds, which offer a combination of safety and growth. When you invest your money into a TFSA, you don't get any tax deduction. However, you can grow the money inside a TFSA without paying any taxes. And finally, you can withdraw the money from a TFSA without paying any taxes. Any admin fees you pay, or if you borrowed the money to invest into a TFSA, the interest costs are not tax deductible. One unique thing about a TFSA, when you withdraw money, it adds to your limit next calendar year. Let me explain. Let's say you have a limit of $50,000 and you put $30,000 inside a TFSA. Let's say the funds do very well. Now your value of a TFSA is $60,000. Now you end up withdrawing that $60,000. Next calendar year, on January 1st, that $60,000 that you had withdrawn adds to your limit. So your limit next calendar year would be the $60,000 that you withdrew plus the additional limit that CRA would give you that calendar year. Also note, withdrawals do not affect your old age security, guaranteed income supplement, or any federal income benefits. So how can you open one? You have to be 18 years older and be a tax resident of Canada. That's it. Some provinces require you to be 19, but when you open the account at 19, you will be allowed to use a limit for the 18-year-old. Let's talk about the limits. In Canada, CRA allots a limit to every Canadian. Your room starts accumulating even if you didn't file your taxes or even if you didn't open up a TFSA. So how big is your limit or how big is your bucket as how much can you put into a TFSA? Every year CRA has a limit. The limits have been increasing since 2009. For example, if you were over the age of 18 and were in Canada since 2009, your limit this year is $95,000. Mistake number one, withdrawing and contributing the same calendar year. When you withdraw money out of a TFSA, that room opens up, but it opens up in the next calendar year. So if you end up withdrawing some money and putting it back in that particular calendar year, CRA considers that as additional investment into your TFSA and may charge you a 1% penalty every month. Mistake two, transferring TFSAs from one institution to another. You should never withdraw the TFSA and then invest into another institution because that would again cause you to pay the penalty. Instead, use proper paperwork to transfer from Bank A to Bank B. Mistake number three, using a TFSA for day trading. Day trading, in CRA's view, can be considered as business activity, and CRA can end up taxing the profits as business profits. So the gains can be considered as business income and may be taxed accordingly. Mistake number four, keeping the money in cash. What's tax-free in a TFSA is growth, and if you keep the money in cash, there is no growth, and so there is no benefit of putting money into a TFSA. You're merely wasting the precious room in your TFSA. Mistake number five, not everything is tax-free. US-based investments, like dividends from US-based stocks, are subject to 15% withholding tax even inside a TFSA. If you enjoyed this video, then you might enjoy this video where I cover whether you should use an RSP or a TFSA and which one is better.